Usually when we talk about a software company updating its platform, it's this incredibly polite, almost timid negotiation.
Oh, yeah.
You get that little pop-up window in the corner of your screen saying, hey, we have some exciting new features waiting for you whenever you have a spare moment.
Right. And as the user, you just click Remind Me Tomorrow. And you do that for, I don't know, about 6 months straight.
Exactly. It's totally optional. I mean, the company just bends over backward to make sure you're comfortable.
Yeah. They keep the old legacy version running, pushing out these minor security patches just in case you don't like change.
Because the standard corporate playbook, especially in enterprise software, is that you never, ever alienate a paying customer.
Never.
You just do whatever it takes to hold on to every single dollar of revenue, even if it means maintaining systems that look like they were built in the 1990s.
Which is exactly why what we are looking at today is so jarring.
Jarring is the perfect word. So, welcome to this Talk Tickers edition of our deep dive. We are jumping into the cybersecurity arena today, specifically looking at Varonis Systems, ticker symbol VRNS.
And that polite little pop-up window you mentioned, yeah, they've deleted it.
They really have. Varonis is essentially issuing a hardline ultimatum to a massive chunk of its paying customers. Basically saying, upgrade to our new cloud platform or we are permanently cutting you off.
It's a controlled demolition of their own legacy revenue base.
Seriously.
They are deliberately forcing their own clients to migrate, knowing full well, and admitting on their earnings call, by the way, that they are going to lose tens of millions of dollars in contracts in the process.
And that raises the core tension of this entire deep dive. We're breaking down their Q4 2025 earnings call today, keeping you, the retail investor, squarely in mind.
Right.
And we have to figure out, is this forced migration a masterstroke of corporate efficiency? Are they shedding dead weight to build a leaner, vastly more profitable machine? Or are they amputating a perfectly healthy limb just to look sleeker for Wall Street, potentially jeopardizing their market share?
It is a fascinating high-stakes case study. I mean, Varonis has built this massive reputation in a very specific niche, which is data security.
Yeah.
But right now, they are in the middle of a brutal corporate metamorphosis. They are transforming their entire architecture from the inside out.
And the financial shockwaves of that transition are completely scrambling how their numbers look on paper.
Oh, completely. If you just glance at their top-line revenue on a stock screener, you are missing the entire plot.
Which is exactly why we need to break this down logically. Our mission today is simple. First, the headline numbers. Second, the story driving those numbers. Third, management's forward guidance. And finally, the bottom line.
Sounds good.
So before we get to the financial engineering, let's make sure everyone understands the actual engineering. What does Varonis actually do that makes them so confident they can issue an ultimatum to Fortune 500 companies?
Well, they don't just put a firewall around a company's network. Firewalls keep bad actors out of the building.
Right.
Varonis operates on the assumption that the bad actor is already inside the building, sitting at a desk.
Okay.
They do data-centric security, so they monitor the actual files, the folders, the internal emails, the raw intellectual property.
So it's very granular.
Extremely granular. They map out exactly who is touching what data, and more importantly, they use massive amounts of behavioral analysis to figure out who has access to data they shouldn't be touching.
Like if an employee's account suddenly starts downloading, say, 50,000 files at 3:00 a.m.
Exactly. They are the internal vault guards.
Okay, so with that context, let's look at the financial data. Because before we can judge the brilliance or the madness of management strategy, we have to look at the raw scoreboard.
Let's do it.
And in the software world, especially during a transition like this, the ultimate scoreboard is ARR.
Annual recurring revenue.
Right. Total Q4 revenues hit $173.4 million. That's up 9% year over year. But total ARR landed at $745.4 million, which is up 16% year over year.
Yep.
For anyone trying to value this stock, why do we care so much more about the $745 million number than the actual revenue that hit the bank account this quarter?
Because recognized revenue in enterprise software can be incredibly noisy, especially when you are changing business models.
Oh, so?
Well, total revenue can include one-time consulting fees to help a company set up their servers. It can include hardware quirks.
Oh, I see.
Or it might reflect a massive multi-year contract that was paid all up front, but accounting rules say it has to be recognized slowly over time. It just obscures the actual momentum of the business.
So ARR strips all that away.
Exactly. ARR tells you exactly how much predictable subscription-based cash is contractually guaranteed to walk in the door over the next 12 months.
Right.
It is the purest measure of the company's baseline engine. If ARR is growing predictably, the company is fundamentally healthy and compounding its value.
Regardless of how messy the quarterly accounting looks due to one-off migration costs.
Precisely.
So the total engine is $745 million, growing at 16%. Solid.
Very solid.
But underneath that hood, the parts are being swapped out while the engine is still running. And the metric doing all the heavy lifting here is their SaaS ARR, software as a service.
The cloud-based version of their product.
Right. In Q4, their SaaS ARR hit $638.5 million. That means this new cloud platform now makes up a massive 86% of their total ARR.
And we really have to look at the velocity of that segment. Their SaaS ARR grew 32% year over year.
Wow. 32%.
And crucially, that 32% growth is when you exclude the customers they simply forced over from the old platform.
Wait, really? So that's just organic?
That is organic, newly generated business in the cloud. Yes.
That's huge. To put a mechanical analogy on this for you guys listening, think of Varonis' legacy business. The on-premise software a company physically installs on its own basement servers as being like selling a standalone electrical generator to a house.
Okay, I like that.
It works, but the homeowner has to maintain it, fuel it, and monitor it. Their new SaaS product is like plugging that house directly into the centralized power grid.
Right.
And Varonis is basically telling Wall Street, hey, the centralized power grid is now 86% of our business. And they're actively discontinuing the generators.
And the metric that proves how aggressively they're discontinuing those generators is their conversion rate. In the fourth quarter alone, Varonis successfully converted a record $65 million of their old legacy on-premise business over to the new SaaS platform.
That is 1/3 of all their remaining legacy business converted in just 90 days.
It's a staggering pace for enterprise software. To put it in perspective, they now have only $105 million of that legacy non-SaaS ARR left on the books.
Wow. So they are nearing the absolute finish line of this architectural transition.
Yeah, really are.
So they're aggressively pushing people onto this new centralized grid. But here is the critical question for a software investor. Once you force a customer to migrate, are they actually happy once they get there?
Right. Do they stick around?
Exactly. Do they stay and do they buy more? That brings us to net dollar retention, or NDR. For their SaaS customers, Varonis reported an NDR of 110%.
Which is an incredibly vital health metric. To break that down, 110% NDR means that even if Varonis fired their entire sales team tomorrow and didn't sign a single new company all year, their existing cohort of cloud customers still spent 10% more this year than they did last year.
Because they bought more licenses, added new modules, that sort of thing.
Right. They expanded their usage. It proves the product has gravity.
Okay, I hear you, but I'm going to push back hard on this.
Go for it.
110% NDR is fine, it's solid. But in the absolute elite tier of the software as a service world, we often see NDRs of 120%, 125%, even 130% from companies like Snowflake or CrowdStrike in their prime.
Sure.
So if Varonis' product is so essential and this new cloud platform is so vastly superior, why aren't existing customers expanding their spend faster? Why is it only 110%?
Management actually addressed this head on, and it comes down to a fundamental bottleneck in human capital. The 110% figure is artificially suppressed by the transition itself.
How so?
Well, throughout 2025, Varonis converted roughly $190 million of legacy business to the cloud. That is a gargantuan technical and logistical heavy lift for the sales and engineering teams.
So the argument is that the sales reps were just too distracted.
Essentially, yes.
Hold on. I'm sorry, but my sales team was too busy. Is the oldest, most convenient excuse in the enterprise software playbook.
I know how it sounds.
It's what management always says when organic growth slows down. I mean, if a product is truly a game changer, upsells shouldn't require a 6-month charm offensive from a sales rep. Customers should be knocking on the door asking to turn on new features.
That's true in some sectors, yeah.
Are we really just taking management's word that this is a bandwidth issue, or does the platform just lack organic upsell velocity?
It's a fair skepticism, but you have to look at the actual mechanics of migrating an on-premise cybersecurity architecture to the cloud. This isn't like upgrading your Netflix account to 4K.
Okay, point taken.
When a massive bank moves from Varonis on-prem to Varonis SaaS, a Varonis sales engineer has to sit down with the bank's IT department. They have to audit years of custom scripts, local server configurations, and deeply embedded Active Directory permissions.
Oh, wow.
Yeah, and they have to meticulously map all of that legacy logic into the new cloud environment without breaking the bank's daily operations or exposing a vulnerability during the transfer.
That sounds intense.
That process can take 6 to 9 months of constant hand-holding.
So it's not that the sales rep is busy making phone calls. It's that the highly technical sales engineers are completely bogged down in digital plumbing.
Precisely. If your best technical salespeople are spending 40 hours a week helping a grumpy legacy customer untangle a decade of spaghetti code just to get them onto the new platform, they physically do not have the hours in the day to go to a happy existing SaaS customer, analyze their environment, and pitch them a new $100,000 database monitoring module.
Okay.
The friction of the migration consumes all the oxygen in the room. Management was clear. Once that remaining $105 million of legacy business is cleared out, those technical reps are unleashed to focus entirely on organic expansion.
Okay, that mechanical explanation makes a lot more sense than just saying they were busy. Let's talk about the bottom line, the actual cash.
Right.
Because you can have all the recurring revenue and migration excuses in the world, but if you're burning cash to achieve it, the market will eventually punish you.
And this is where Varonis separates itself from a lot of the high-growth software pack. They are highly profitable on a cash basis.
Let's hear the numbers.
In 2025, they generated $131.9 million in free cash flow. That is a significant jump from the $108.5 million they generated the year prior.
Let's define that quickly for the retail investor, because free cash flow is very different from the net income you see on a standard income statement.
Very different.
Net income includes all sorts of non-cash accounting charges, like the depreciation of office equipment or how they account for stock-based compensation. Free cash flow is the actual hard cash left over after the company has paid all its operating expenses and all its capital expenditures.
Exactly.
It's the cash that actually hits the bank account, which they can use to weather a storm, acquire another company, or return to shareholders.
And generating $131.9 million in real cash while simultaneously ripping up your own legacy customer base is a testament to the underlying unit economics of their SaaS model. Their gross margins are incredibly healthy, sitting at 80% for the quarter.
Now, that 80% is slightly down from the 84.4% gross margin we saw a year ago. But that makes sense mechanically, right?
Yep.
In the old on-prem model, Varonis just emailed a software license to the client, and the client had to pay for the servers and electricity to run it. In the SaaS model, Varonis has to pay Amazon Web Services or Microsoft Azure to host the software and process all that data.
Right, the cloud hosting costs.
So their hosting costs go up, which pushes gross margins down slightly, but the recurring revenue is so much higher that the total gross profit dollars still increase.
That is exactly how the math works. And what are they doing with that cash? Well, they have a $1.1 billion cash hoard on their balance sheet.
That's a massive war chest.
And in Q4, they used about $15 million of it to repurchase just under 450,000 shares at an average price of $33.45.
I have to admit, that confused me when I read the transcript. $15 million in buybacks is a rounding error when you have $1.1 billion in the bank?
If it is small, yeah.
Why bother? If management thinks the stock is so cheap, why not buy back $200 million?
Because it's not a structural capital return program, it's a signaling mechanism.
Oh, I see.
They aren't trying to artificially inflate the earnings per share by drastically reducing the share count. They are simply putting a floor under the stock, signaling to the market, we believe our intrinsic value is fundamentally higher than $33 a share, and we will step in to buy if it dips here.
Right.
They want to keep the vast majority of that $1.1 billion dry powder available for strategic acquisitions, which, as we'll see later, they are actively doing.
Okay, so that is the financial scoreboard. The transition to the cloud is working, the SaaS revenue is booming, and cash flow is accelerating. But numbers on a spreadsheet don't just magically happen.
No, they don't.
And this brings us to the core engineering reality, which is part 2 of our deep dive. How did they actually manage to get 1/3 of their stubborn legacy customers to rip up their old architecture and move to the cloud in a single 90-day window?
It boils down to 2 massive unavoidable forces colliding: an aggressive corporate ultimatum and the terrifying new realities of how modern cyber threats actually operate.
Let's start with the ultimatum. Management made the highly aggressive decision to officially announce the end of life for their self-hosted on-premise platform.
Yep.
They set a hard, non-negotiable deadline. By the end of 2026, The old product is completely dead. No more updates, no more security patches.
Nothing.
They are telling that remaining $105 million of legacy business, you migrate to our cloud platform or you go find a new vendor. We do not care.
In the enterprise software space, forcing your customers' hands like that is incredibly risky. You're inviting them to go look at your competitors.
Absolutely.
But Varonis' CEO explained exactly why they had to do it, and it comes down to a fundamental, insurmountable technological gap between what a local server can do versus what the cloud can do.
He used an analogy during the call. He said comparing their old self-hosted software to their new SaaS platform is like comparing a bicycle to a self-driving car.
Right.
Now, I want to unpack that because it sounds like standard CEO marketing fluff, but there is actual deep engineering truth to it.
There really is. With a bicycle, yes, you can eventually get to your destination, but you are doing all the pedaling, you are sweating, you are constantly scanning the road for potholes, and you are manually navigating every turn.
Sounds exhausting.
It is. If a company uses the old on-premise Varonis software, their internal IP team is doing all the peddling. They have to manually review the security alerts. They have to manually tune the threat detection rules.
Right.
And when an alert flashes red, a human being has to physically investigate it and manually change the folder permissions to stop the attack.
And what management is saying is that in the context of modern data security, the bicycle approach is no longer just exhausting. It's practically negligent.
It is.
The speed at which data is compromised today means if you rely on a human being to read an alert and click a button, you have already lost.
Exactly. And this highlights a crucial point that separates Varonis' transition from, say, Adobe's transition a decade ago.
Oh, let's talk about that. When Adobe forced everyone to stop buying Photoshop on a CD-ROM and move to the Creative Cloud subscription, it was a massive business model shift, but the technology didn't really change.
Right.
For the end user, a brush tool in Photoshop CS6 on a CD worked exactly the same as a brush tool in Photoshop CC on the cloud. The technological gap wasn't that vast.
But for Varonis, the gap between their on-premise solution and their SaaS solution is a Grand Canyon. And it all centers around a specific service they call MDDR.
Managed Data Detection and Response.
Exactly. This is their elite automated threat hunting service. And management made it very clear on the call. MDDR can only be provided to their SaaS customers. The legacy customers cannot have it.
Why not? Why can't Varonis just update the old on-prem software to do the same automated threat hunting?
Because of compute power and global telemetry. To detect advanced, stealthy threats across a sprawling enterprise network, imagine a hacker quietly elevating their privileges over 3 months. Varonis needs centralized visibility. They need to aggregate petabytes of behavioral data, cross-reference it against threat models from thousands of other global clients, and apply massive machine learning algorithms to spot the anomaly instantly.
And you simply cannot run those kinds of heavy machine learning models on a standard server rack sitting in a hospital basement.
You can't.
The local server physically lacks the computing horsepower.
Precisely. And more importantly, you lack the automated remediation. With the SaaS platform and MDDR, when Varonis detects an employee's account behaving strangely, say, a marketing coordinator suddenly trying to access source code repositories.
Something they should never be doing.
Right. The cloud platform doesn't just send a polite email to the IT guy. In milliseconds, the SaaS platform actively reaches back into the customer's environment, revokes the compromised user's session token, quarantines the specific endpoint, and reverts the Active Directory permissions back to a safe state.
Yeah.
It is a self-driving car taking control of the steering wheel right before a crash.
So the legacy customers who stubbornly hold on to their on-premise versions aren't just holding on to a different payment model. They are actively paying for security software that is functionally obsolete against modern automated attacks.
And to prove just how vast this technological gap really is, we don't have to rely on management's metaphors about bicycles. We have real-world proof from the earnings call.
Let's get into the case studies.
Yeah, let's look at 2 specific case studies from Q4 that show the exact mechanics of why companies are desperately migrating to the Varonis SaaS platform once they see it in action.
Case study number 1. This was a new logo, meaning a brand new customer, not an upsell. A large healthcare service organization was doing a massive risk assessment because they were migrating all their internal data over to multiple public cloud platforms like AWS and Azure.
Now, their first instinct was a very common and very dangerous assumption. They assumed, well, we're paying Microsoft and Amazon millions of dollars to host our data. Surely the native security tools built into Azure and AWS are enough to keep it safe.
Right. But let's explain the difference between native cloud security and data-centric security. Native tools like AWS Macie or Azure Purview are primarily looking at the container.
Yeah.
They will tell you, hey, this database is configured correctly, or this storage bucket is not exposed to the public internet. But they generally do not do deep contextual analysis of the actual data sitting inside the container, mapping out exactly which internal employee is allowed to read which specific file.
So this healthcare organization runs a competitive process. They bring Varonis in to test the SaaS platform alongside the native tools, and almost instantly, Varonis's deep scanning engine uncovers several hundred critical misconfigurations that the native tools completely missed.
And because it's the SaaS platform, it didn't just generate a massive spreadsheet of problems, it used its automated remediation capabilities to instantly fix many of those misconfigurations without human intervention.
Which is huge.
But the real kicker, the thing that closed the deal, was what Varonis found hiding deep in the data itself.
Yeah. Varonis identified over 900,000 exposed, personally identifiable information records.
900,000.
900,000 PII records, things like patient names, addresses, social security numbers, alongside highly sensitive executive strategy materials. And they were just sitting there internally exposed.
Meaning any employee who knew where to look in the internal network could have accessed them.
Exactly. The moment the chief information security officer sees that dashboard showing nearly 1 million exposed patient records that their native cloud tools ignored, the debate is over.
I would imagine so.
The customer immediately bought the full Varonis SaaS suite, including the MDDR service, to cover all their cloud environments.
This perfectly highlights the core value proposition.
Yeah.
Visibility is not enough anymore. Just telling a company they have 900,000 exposed records actually creates a massive liability and panic, but it doesn't solve the problem.
Right.
Varonis's ability to automatically remediate those internal access risks at scale is why they win against competitors.
Now, let's look at case study number 2, because this illustrates exactly why the legacy customers are finally converting when pushed. This was a massive hospital system, 45,000 employees.
Okay.
They were an existing Varonis legacy customer who had originally bought the old on-premise software years ago, specifically just to monitor a HIPAA data on their local physical servers.
Management referred to this as a classic single-threaded legacy customer. They bought the tool for one very narrow compliance use case, and they were only using a fraction of the tool's actual capabilities.
But then this 45,000 employee hospital system starts migrating its operations to the cloud. And they quickly realize that trying to map 45,000 different employee roles, permissions, and access levels across a hybrid cloud environment is an absolute nightmare.
I can't even imagine.
Their native tools couldn't handle the complexity of remediating data overexposure at that scale. So Varonis comes in and does a risk assessment using the new SaaS platform. And what do they find?
What'd they find?
Over 500,000 instances of HIPAA data and PII open to literally everyone in the organization.
500,000. Think about the mechanics of that. Due to sloppy internal permissioning, what we call over-permissioning or shadow IT, any employee, from a chief pediatric surgeon to a newly hired cafeteria worker who just got their internal email address, could theoretically click through the shared network drives and access highly sensitive patient diagnosis data.
Yep.
From a regulatory standpoint, it is a catastrophic compliance violation waiting to happen.
And again, the moment Varonis demonstrated the SaaS platform's ability to not only map out that insane web of 500,000 exposed permissions, but to automatically lock them down to a least privilege model, meaning employees only have access to the exact data they need for their job and nothing else, the hospital converted.
They saw the value immediately.
They immediately ripped out the old on-prem software, upgraded to the SaaS platform, and bought the MDDR service.
These real-world case studies bridge the gap between abstract financial metrics like conversion rates and the operational reality on the ground. When you can instantly show a hospital board 500,000 internally exposed patient records and then show them the software automatically fixing the permissions in real time, the financial friction of the upgrade vanishes.
The software justifies its own cost instantly.
But the story of this massive SaaS growth doesn't end with simply upgrading old technology. The second And arguably more explosive tailwind driving Varonis' growth right now is the AI revolution.
Oh, yeah.
And this is where the earnings call got genuinely fascinating, borderline sci-fi.
It really did. The CEO dedicated a significant portion of his opening remarks to detailing exactly how artificial intelligence is fundamentally altering the threat landscape for every company on Earth.
When the average investor thinks of a cyber attack, we usually think of a hacker trying to brute force a password or break through a firewall, typing furiously on a keyboard in a dark room.
Right, the guy in the hoodie.
Exactly. But management made a chilling paradigm-shifting point. Modern, sophisticated attackers aren't hacking computers anymore. They are hacking trust. And they are using highly autonomous AI agent to do it.
He specifically referenced recent incidents where Chinese state actors used cloud code and automated scripts to breach major Western corporations.
What does hacking trust actually mean in a mechanical sense?
It means the attackers aren't trying to break down the front door. They're using AI to steal or spoof the digital ID badge of an employee who already has access.
Okay.
They use AI to generate flawlessly written spear phishing emails or deepfake voice calls to the IT help desk to reset a password or automated scripts that scour GitHub for accidentally exposed OAuth tokens.
So they trick the humans.
Right. Once the AI agent steals that credential, it logs into the network looking perfectly legitimate. The firewall sees an authenticated user and lets them right in.
So the bad actors are using AI to bypass traditional perimeter security. But the internal dynamic is just as dangerous. At the same exact time that hackers are using AI to attack, the corporations themselves are absolutely desperate to roll out internal AI tools.
Things like Microsoft CorePilot or custom enterprise chatbots to make their own employees more productive.
And this creates a massive, almost paralyzing internal tension for chief information officers. Companies feel the immense competitive pressure to adopt AI as quickly as possible. If their competitors are using AI to draft contracts in 10 seconds, they have to do it too.
Absolutely.
But they are absolutely terrified of the data security implications of turning an AI loose on their internal network.
This is the crux of the issue, and it requires us to understand exactly how these internal AI tools work. Let's talk about a concept called RAG retrieval augmented generation.
Break that down for us.
When a company installs an internal AI chatbot, the AI itself doesn't actually know everything about the company. When an employee types a question into the prompt, the AI uses Array to rapidly search the company's internal servers, SharePoint, OneDrive, Google Drive, to find relevant documents, read them, and summarize the answer for the user.
And here's the fatal flaw. The AI agent assumes the identity and the permissions of the employee asking the question.
Exactly. An AI agent is only as safe as the data it is technically allowed to access. Let's say a hospital rolls out an AI assistant to help doctors summarize patient notes, but the internal IT permissions are sloppy, just like we saw in that case study with the 500,000 exposed IPA records.
Right.
If the AI isn't strictly siloed, a curious mid-level manager could type a simple prompt into the company AI asking, "What are the latest salary bands for our executive team?" or summarize the upcoming merger and acquisition documents.
Oh man. And because the internal folder permissions are broken, the AI agent searches the network, finds the CEO's unprotected strategy folder, cheerfully reads the highly classified documents, summarizes the company's biggest secrets, and hands them right to the mid-level manager.
The AI isn't malicious, it's just dangerously helpful. It operates faster than humans, it collaborates autonomously, and by design, it attempts to maximize its reach to fulfill the user's request.
Wow.
As management put it plainly, AI security depends entirely on data security. You cannot safely deploy Microsoft CorePilot or any enterprise AI if you do not know exactly what data it is allowed to touch. If your internal data permissions are a mess, AI will turn that mess into a weapon.
And Varonis saw this massive industry-wide panic and made a highly strategic move. During the Q4 call, they officially announced the acquisition of a company called Altru, which specializes specifically in AI security and governance.
This feels like a brilliant synergistic play. Let's explain how these two technologies fit together. Think of a bank. If Varonis is the state-of-the-art vault protecting the gold being the highly sensitive corporate data, then Altru is the advanced background check and surveillance system monitoring the employees walking into the bank.
That's a great analogy.
But in this digital context, the employees aren't humans. They are the various AI agents, co-pilots, and machine learning tools the company has plugged into its network.
That is a highly accurate mechanical way to visualize it. Varonis does the heavy lifting of protecting the underlying data, mapping the identities, and fixing the folder permissions so only the right people have access. Altru comes in a layer above that.
Right.
It automatically discovers and inventories every single piece of AI infrastructure a company is using.
Yeah.
It sets behavioral guardrails.
So if an employee tries a prompt injection attack, basically trying to trick the internal AI into ignoring its safety rules and revealing sensitive data, Altru acts as the filter that spots the malicious prompt and blocks the AI from executing it.
Precisely. It monitors how those AI tools behave, and most importantly, it monitors how different AI agents interact with the data pipelines. So Altru makes sure the AI agent isn't going rogue or being manipulated by a clever employee prompt.
And Varonis makes sure that even if the AI does somehow go rogue, or if a hacker compromises an AI agent, the sensitive data itself is locked down so tightly with least privilege permissions that the AI simply cannot read it anyway.
Belt and suspenders.
It is a comprehensive belt and suspenders approach to the biggest technological shift of the decade.
And there is a crucial structural advantage here regarding how Varonis executes this acquisition. Because Varonis has spent the last 3 years aggressively forcing its architecture into the cloud, they can integrate an acquisition like Altru incredibly fast.
They don't have to wait to mail out physical software updates or CDs to thousands of local hospital servers. They just fold the Altru code directly into their centralized SaaS platform and offer it as a premium module to their clients instantly.
Okay, so up to this point, the narrative is phenomenal. The core data product is mechanically essential, the cloud migration is vastly superior and happening at record speed, and they have perfectly positioned themselves as the mandatory security prerequisite for the enterprise AI boom. It sounds like a total slam dunk for investors.
It does.
But this brings us to part 3 of our deep dive. Management guidance and the intense drama that unfolded during the analyst Q&A.
Here we go.
Because when we look ahead to the financial projections for 2026, the optics of this transition get really, really messy.
Indeed they do. Navigating a corporate transition of this scale is never perfectly smooth, and Varonis is deliberately changing the very math they use to report their success to Wall Street.
Which is always a red flag for analysts.
Anytime a management team changes its KPIs, its key performance indicators, analysts instinctively get very anxious and highly suspicious.
So the CFO announced on the call that to help investors understand the final stages of this transition, they are introducing new reporting metrics for 2026. He explicitly stated that the single most important metric they want the market to focus on moving forward is a customized figure, SaaS ARR excluding conversions.
Let's break down the mechanics of why they are doing this and why it's controversial. Total SaaS ARR for 2026 is guided to hit somewhere between $805 million and $840 million.
Okay.
If they hit the high end of that, it would represent roughly 32% growth, which for a company of this size is fantastic.
But the CFO is telling everyone to completely ignore that big, flashy 32% total growth number. He is essentially pulling a sleight of hand, saying the true pulse of the company is the organic SaaS ARR growth.
Right.
He only wants investors to look at the growth that comes from signing brand new logos or upselling existing cloud customers on new modules like Altru or MDDR. He wants to completely strip out the millions of dollars in revenue they get from merely migrating their old legacy on-premise customers over to the cloud. Why intentionally lower the bar and ask Wall Street to look at a smaller growth number?
Because management knows that the conversion well is about to run permanently dry. As we noted earlier, there is only $105 million of legacy business left. By the end of 2026, those customers will all be migrated or they will be gone.
That makes sense.
The CFO is trying to condition Wall Street now to judge the company based solely on its underlying ability to generate true, organic, net new business. And that specific metric, SaaS ARR, excluding conversions, is guided to grow at a much more modest 18% to 20% in 2026.
So 18 to 20%.
In pure dollar terms, that equates to adding roughly $120 million in net new organic ARR.
Now, to make absolutely sure the company actually hits that 18 to 20% organic growth target, management is pulling the biggest, most aggressive lever a software organization has at its disposal.
The comp plan.
They are completely rewriting the sales compensation plan.
This is a critical operational detail that dictates how the company actually functions day to day. You have to understand the psychology of enterprise sales.
Oh, absolutely.
Salespeople, by nature, will always take the path of least resistance to hit their quota. Throughout 2024 and 2025, Sales reps made massive commission checks simply by holding the hands of legacy customers, convincing them of the ultimatum, and moving their existing spend over to the cloud.
Right, it was low-hanging fruit.
It generated huge conversion numbers, but it didn't necessarily bring in new money.
But for 2026, management has changed the rules of the game. The new comp plan strictly prohibits sales reps from retiring their quotas through legacy conversions. Think about how jarring that is.
Very jarring.
If a highly paid sales rep spends 3 months migrating a massive legacy customer to the cloud, securing $1 million contract renewal, that rep does not get credit toward their main organic sales goals. The commission is drastically reduced for that specific action.
Right.
To make the big commission checks in 2026, the sales team must hunt down.
It forces the entire sales organization to pivot instantly from a mindset of migration to a mindset of true expansion. It is a bold, necessary shock to the system to ensure the company doesn't stall out when the legacy conversions dry up.
So if the underlying organic growth is a solid 18 to 20%, and they have aligned the sales incentives to hit it, why were the Wall Street analysts on the earnings call getting so prickly?
Well, this brings us to the $30 to $50 million headwind.
Right. Management shocked a lot of passive observers by guiding for a significant, highly visible hit to their free cash flow and ARR contribution margins in 2026.
And this all traces back directly to the aggressive ultimatum we discussed at the very beginning of the show. By forcing the absolute end of life for the old on-premise platform by the end of 2026, management is fully publicly acknowledging that not everyone will comply. They are willingly going to lose customers.
The biggest, most stubborn holdouts are federal and state government agencies. Government entities are notorious for moving at a glacial pace, but more importantly, many of them have strict, non-negotiable security architectures. Some of these agencies operate air-gapped systems.
Let's define an air-gapped system because it's crucial here. An air-gapped system is a computer or network that is physically permanently disconnected from the public internet or any other unsecured network.
Like a bunker.
Think of a server sitting in a locked basement at the Department of Defense. You literally have to walk into the room with a USB drive to put data on it. It is physically impossible for an air-gapped server to connect to Varonis's centralized cloud platform.
Furthermore, some government entities have strict legal mandates that forbid them from hosting certain classifications of citizen data on a multi-tenant public cloud, regardless of how secure it is. They literally cannot convert to the SaaS model even if they wanted to.
And Varonis management is looking at those massive multi-million-dollar government contracts, shrugging their shoulders and saying, "We are fully prepared to lose your business." Wow.
They are willing to take a $30 to $50 million hit to their ARR in 2026 just to be rid of them.
I want you to clarify this for me because to a casual observer or a standard retail investor looking at a balance sheet, intentionally throwing away up to $50 million in government revenue sounds like an unmitigated disaster. It sounds like terrible management. But you're telling me this is actually a masterstroke?
I am. This is a classic textbook example of a highly bullish signal masquerading as a bearish one. You have to look at the invisible math of software development. If Varonis compromised on their ultimatum and decided to keep supporting that legacy government business, think about the immense hidden costs involved.
You're talking about technical debt.
Exactly, technical debt.
Yeah.
If you keep the on-premise software alive for a few stubborn government clients, you have to maintain an entire dedicated team of highly paid software engineers whose only job is to patch and update the outdated bicycle code.
Every time Varonis invents a brilliant new feature for the cloud, they would have to waste thousands of engineering hours trying to build a clunky, backward-compatible version for the government's basement servers. You have to run a bifurcated customer support desk. The operational drag of supporting a shrinking, fundamentally obsolete product line grows exponentially over time. It suffocates innovation.
It's kind of like a major television network keeping a massive, expensive VHS manufacturing plant open and fully staffed just because a few loyal, high-paying customers refuse to buy a streaming box.
That's a perfect analogy.
Yes, those customers pay you money, but the cost of keeping the VHS factory running drains critical resources away from the future of your streaming platform.
That is exactly what technical debt does. By taking the $50 million financial hit on the chin right now, in a single year in 2026, Varonis is aggressively clearing the decks. They are eliminating an immense amount of technical debt and administrative overhead.
So they're ripping the Band-Aid off.
Yeah. Once those legacy government contracts roll off the books, the entire company becomes radically leaner. 100% of their engineering talent, 100% of their support staff, and 100% of their sales efforts will be focused entirely on the high-margin, scalable SaaS platform. Taking the hit now paves the way for a massive explosion in profitability and cash flow by 2027 because they won't be dragging that dead weight anymore.
But here's the problem. Wall Street analysts live in the immediate present, and their financial models do not handle messy optical transitions well. The tension during the Q&A section of the call was absolutely palpable.
Oh, it was tense.
Some analysts on the call pointed out a very real, very ugly math problem that is going to plague the stock chart in 2026.
Yeah, they did.
If you take the total ARR that Varonis exited 2025 with, and you compare it to the projected total ARR at the end of 2026, accounting for the lost $50 million in government contracts and the normal churn of legacy clients who refuse the ultimatum, the overall top-line growth rate for the entire company mathematically shrinks to a measly 10%.
And for a high-flying, premium-valued cybersecurity software stock, 10% overall growth sounds like an absolute death knell. Software companies growing at 10% get assigned value stock multiples, not hypergrowth multiples.
All right.
Some analysts basically challenge management directly, asking, how do I square this 18-20% organic SaaS growth you keep bragging about with the reality that the total company on paper is only growing 10%?
And management continuously, almost stubbornly, redirected the analysts. The CFO basically told them they were looking at the wrong part of the machine. He argued that the legacy churn, that $50 million hit, is a ghost of the past. It's irrelevant to the future cash flows.
Yep.
Management is aggressively asking Wall Street to look only at the thrust of the new SaaS engine, which is roaring at 20%, while the analysts are pointing out that the fuselage of the plane is still dragging along the runway, slowing the whole thing down.
It was a fascinating standoff. Management is demanding the market value them based on their highly profitable, pure SaaS future state, and the analysts are saying, yes, but our models have to account for the total revenue reality of today.
Which brings us perfectly to the final phase of our deep dive. The bottom line. We have unpacked the data mechanics, the AI integration, the uncompromising ultimatum, and the messy guidance optics. What is the actual actionable takeaway for you, the retail investor holding or considering buying VRNS? Let's start by laying out the bear case.
The bear case is deeply rooted in this optical pain and market mechanics. 2026 is going to be an ugly, highly confusing transition year on paper. Headline total ARR growth will look weak, hovering around that 10% mark as they systematically shed the $30 to $50 million in legacy government contracts.
And we have to acknowledge how modern markets function. A massive portion of daily trading volume is driven by passive index funds and algorithmic trading models.
Yeah, absolutely.
These algorithms often don't listen to the nuanced explanations on an earnings call. They just scrape the SEC filings and scan the headline top-line growth numbers. When an algorithm sees a cybersecurity stock's growth decelerate to 10%, it might automatically trigger a sell order. The stock could face serious, relentless technical pressure throughout 2026 and look like it is fundamentally stalling out.
Plus, beyond the algorithms, there's severe execution risk. Management has put a lot on their plate. They aren't just transitioning their sales compensation model to force organic growth. They are actively trying to integrate two major technology acquisitions, Altru and another company called FlashNext, into their platform simultaneously.
Right, that's a lot to juggle.
If they stumble on the technical integration of Altru, or if the newly restricted sales team fails to hit their organic quotas under the strict new compensation plan, that 18-20% target could slip. The bears will argue there is simply too much structural risk, too many moving parts in 2026 to justify holding the stocks through the turbulence.
But then there's the bull case. And the bull case is fundamentally about structural advantage and the finality of the transition. Management has successfully pulled off the hardest, most dangerous maneuver in enterprise software, forcing an entrenched, stubborn customer base to abandon their physical servers and move to the cloud.
They practically bullied their customers into the future, but the underlying technology was so vastly superior that it worked. By the end of 2026, the legacy drag will be completely dead. Zero on-premise technical debt, zero bifurcated engineering teams. They will emerge in 2027 as a high-margin, highly focused, 100% SaaS machine.
Furthermore, the AI revolution isn't just a marketing buzzword for Varonis, carefully sprinkled into a press release to artificially inflate the stock price. It is a literal, tangible, mechanical driver of their product demand.
It really is.
Every Fortune 500 company on Earth is racing to deploy internal AI agents and copilots. And they're all simultaneously realizing that if they don't have Varonis-level folder-by-folder data security in place first, those AI agents will bypass traditional firewalls and leak their proprietary corporate data internally like a sieve. Securing the underlying data is a mandatory, non-negotiable prerequisite for the entire AI boom.
So what is our actionable verdict at Talk Tickers? After looking at the underlying ARR momentum, the strategic cushion of technical debt, and the massive AI tailwinds, we are taking a definitive stance. This is a bullish signal for the long-term holder, but it requires an iron stomach and extreme patience in the short term.
I agree completely. The 18 to 20% organic SaaS growth is the true beating pulse of the underlying enterprise. The legacy churn, that $50 million hit, is a deliberate, self-inflicted wound necessary for long-term survival and margin expansion.
Exactly. If the broader market panics and punishes the stock in 2026 because the headline total growth looks weak, if the algorithms indiscriminately sell off VRNS due to the optical headwinds of those lost government contracts, it creates a massive potential mispricing.
Right.
For the patient retail investor who understands the underlying mechanics, 2026 could offer a tremendous, prolonged buying opportunity.
It allows you to load up on shares at a discount before the broader market wakes up to the company's highly profitable, pure SaaS reality in 2027.
You are actively trading short-term optical pain for long-term structural dominance. If you believe the data security market is only going to become more complex and critical as AI proliferates, Varonis is uniquely positioning its architecture to capture a massive share of that high-margin ecosystem.
Thank you for joining us for this extensive Talk Tickers edition of our deep dive. We hope this framework helps you cut through the confusing earnings call noise, ignore the algorithmic panic, and see the actual machinery driving the stock. But before we go, I want to leave you with one final, deeply provocative thought regarding the future of cybersecurity.
We spent a lot of time today talking about AI agents as tools that humans use. A human employee asks a prompt, the AI uses RC to retrieve a document, and the AI answers. But the CEO briefly mentioned a chilling, fast-approaching concept during his remarks: agents talking to agents.
We are rapidly entering an era where AI will not just be answering human questions. AI bots will autonomously negotiate and execute complex tasks with other AI bots entirely in the background, operating at the speed of light, with absolute zero human input.
Imagine a scenario. Your company's AI scheduling agent realizes a project is delayed. To fix it, it autonomously reaches out to a third-party vendor's AI procurement agent to order more supplies.
The two bots negotiate the price, and to finalize the contract, your bot temporarily grants the external bot elevated network privileges to access the legal folder and sign the invoice. They do all of this in 3 milliseconds while you are sleeping. Neither bot has human common sense. They are just executing code to achieve a goal.
As an investor, or honestly just as a vulnerable participant in the modern digital economy, ask yourself this. When AI operates entirely in the shadows, dynamically negotiating network permissions and executing commands millions of times a second without us even knowing it's happening, does traditional perimeter cybersecurity, the firewall at the front door, even stand a mathematical chance?
Or will absolute folder-level data-centric lockdown, the exact kind of deep tissue security Varonis provides, be the only wall left standing between order and total corporate compromise?
Because if traditional security can't stop agents talking to agents, that polite little software update pop-up window we joked about at the beginning of the show, we're going to wish that was the most disruptive thing happening on our computer screens.
Something to seriously chew on before the next earnings season. We'll see you next time on The Deep Dive.